Hello and welcome to another US Market weekly news summary. We felt that the market took a pause this week. The credit crunch that has been the concern of the markets over the last few weeks seemed to fade into the background as the consumer and the US recession came sharply back into focus this week. A warning from one of the retailing giants, J.C. Penney, about the cutback in consumer spending really had the markets a bit concerned. When you consider that the US consumer accounts for about 75% of US economic activity, it is worrying when it's clear now that the consumer is starting to tighten their belt. With the focus this week more on the US consumer, the worries of the credit crunch and the banking sector, and particularly the climax of the Bear Stearns buyout last week, have really been sidelined for the time being, but we really feel that it won't be too long before those worries will resurface. And between the consumer concerns and the ongoing credit crunch concerns, we still feel that there's plenty of more bad news to come out. With this in mind, we don't think the overall scenario is improved in any way. It may consolidate for a while longer, but we still feel that there's another down leg to this market coming up very, very soon. Let's take a look at the Nasdaq index. We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year, really from just before Christmas. We had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark at 2,208 was the worst level before we had the pullback that we've had in the last week or so on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut, followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback of consolidation over the next few weeks, before then the market would probably turn southwards again. So the drift downward seems to have started again, and after the rally of the previous week carrying over into the beginning of last week, the market really sold off continuously till Friday, and at the close on Friday was looking rather weak again. But we think the market might well consolidate for a little bit further, because with the start of the earnings season in April starting very shortly, we think the market will really pause until the overall feeling of how that earnings season is going to progress comes through. We don't think it's going to be a good earnings season by any means. Surely the slowdown in economic activity over the last 2 months has to now filter through into the next quarter. And even though many of the companies up to now have seemed to have been braving the economic storm, we feel that this earnings season may be the start of the real truth coming out. Even if you put aside the ongoing credit and banking liquidity worries and concentrate on the two other factors that seem to be affecting this market strongly, i.e. the elevated energy prices and the costs of energy, combined with the obvious slowdown in economic activity now filtering through to consumer confidence and consumer spending, it's very difficult to see how this next season, this second quarter, will allow a corporate earnings report for the first quarter that will please the market. It has to impact on corporate earnings for the first quarter. When you also consider that we're only 4.5 months into this bear market, and typically bear markets last from 9 months up to 2 years on average, there's still a lot of cause for concern. We'll be watching carefully. Until next week, it's goodbye from London.